What if a distributed ledger technology could process thousands of transactions per second with fees under a fraction of a penny, powering everything from instant global payments to high-frequency asset trading, all without the end user even realizing they are interacting with crypto? For years, this has been the ultimate milestone that the Solana network has been chasing since its genesis. Now, with the massive Firedancer upgrade advancing through validator testing alongside the Agave client overhauls, the network is moving closer to turning high-speed retail decentralized applications into an invisible, friction-free, everyday reality. This is educational content only, not financial advice. Crypto assets are high risk. You could lose all your money. Some description links may be affiliates. I may earn a commission at no extra cost to you. Solana was founded in 2018 by Anatoly Yakovenko, a seasoned software engineer with over a decade of experience at Qualcomm, optimizing distributed systems, designing operating systems, and developing compression algorithms for cellular hardware. He co-founded Solana Labs alongside Raj Gokal and a team of engineers from Qualcomm, Intel, and Apple. The mainnet launched in March 2020. Yakovenko remains actively involved in guiding the network's technical direction. Today, the independent Solana Foundation handles ecosystem grants and developer support, while thousands of independent validators around the world run and secure the live network. This engineering-first background has shaped Solana's focus on performance and scalability from day one. At its core, Solana is a high-performance Layer 1 distributed ledger technology optimized for speed, low cost, and high throughput. It was designed to solve the scalability limitations that make many other networks feel slow or expensive for everyday consumer use. The original architecture combined several innovative components: proof of history for cryptographic timestamping of events, and Tower BFT for consensus built on that time source. It also included Gulfstream for pushing transactions ahead of time to validators, and Turbine for efficient block propagation across the network. Finally, C-Level allowed for parallel execution of smart contracts across multiple CPU cores. Analytical. Together, these allow theoretical throughput in the tens of thousands of transactions per second. They also enable real-world performance that supports complex, decentralized applications without congestion for most users. As adoption grew and retail-scale demand increased, validator vote traffic began consuming a large share of block space, sometimes 50 to 75%. To address this and prepare for broader global usage, the network is undertaking its most significant client and consensus overhaul yet. This overhaul includes the Firedancer independent validator client, alongside core optimization upgrades from the Anza engineering team. These upgrades replace key legacy bottlenecks with modernized data and networking layers. To optimize validator voting, recent protocol implementations like SIMD-0033 alter how vote credits are awarded. Meanwhile, ongoing network optimizations reduce the absolute impact of vote transactions on standard user block capacity. This structure frees up a substantial portion of block space for actual user transactions and applications. Data distribution has also been significantly improved by hardening the network against spam using advanced quick protocol integration. This implementation utilizes localized fee markets and optimized streaming architecture so that block data is broken down and delivered across the global validator set more efficiently. This change makes better use of available bandwidth even under high load. Performance data from ongoing test clusters is promising. While legacy iterations faced challenges with deterministic finality under extreme block congestion, the introduction of Firedancer targets highly resilient, sub-second deterministic finality. It also targets a theoretical execution capacity exceeding 1 million transactions per second. That brings settlement times close to what users experience with a credit card swipe or a traditional centralized database query. For retail apps like payments, gaming, or real-time trading, this level of responsiveness can make decentralized technology feel seamless rather than noticeable. The native token SOL serves as the fuel for the entire network. Unlike tokens with a strict hard cap, SOL follows an inflationary model with a built-in disinflationary schedule designed to balance security incentives and long-term scarcity. Inflation began at 8% annually and decreases by 15% each year until it reaches a long-term floor of 1.5%. The current annual inflation rate sits around 3.8%. Newly issued SOL primarily rewards validators and stakers who help secure the network. Roughly 68 to 70% of the total supply is currently staked and locked, contributing directly to economic security. SOL has clear utility beyond speculation. Every transaction on the network requires a small fee paid in SOL. Importantly, 50% of all collected fees are permanently burned, removing tokens from circulation. As real usage, payments, DeFi activity, NFT trading, or tokenized asset transfers continues to grow, this burn mechanism creates ongoing deflationary pressure that offsets new issuance. This design ties the token's value dynamics to actual network demand rather than pure hype. Participants also use SOL for staking to earn rewards and help govern the network through delegation, adding further layers of utility. This is the area many viewers want to understand most clearly: how Solana is moving beyond retail speculation into practical, real-world applications and institutional workflows. The network's combination of ultra-low median transaction fees, well under a penny, and fast finality makes it a strong candidate for consumer scale and enterprise deployment. Ecosystem metrics show strong traction, including millions of active token holder addresses monthly, alongside consistently high transaction volumes. On the regulatory front, Solana has benefited from improving market structure conversations. While global frameworks continue to evolve, major digital asset managers have officially filed applications for spot Solana ETFs in the United States. They are aggressively pushing the narrative that SOL functions as a digital commodity. While the regulatory landscape remains dynamic, this ongoing institutional push helps reduce long-term uncertainty for builders and users. These spot SOL ETF filings mark an important milestone for traditional investor access. Leading global issuers, including VanEck, Canary Capital, and Bitwise, have products moving through the regulatory pipeline. If approved, these regulated vehicles would allow everyday brokerage account holders to gain exposure without needing to manage private keys or self-custody. This would significantly lower the barrier for institutional portfolios and retirement accounts that require compliant structures. Real-world asset tokenization has gained substantial momentum on Solana. Institutional issuers have brought yield-bearing funds, corporate credit lines, and other instruments on-chain. These additions are pushing total tokenized RWA value to milestones surpassing $2 billion. The expansion of institutional tokenized offerings, alongside developments in tokenized deposits and digital stablecoins, highlights this trend. Partnerships continue to expand the practical footprint. PayPal has integrated its PYUSD stablecoin deeply into the ecosystem for fast, low-cost merchant settlements. Shopify merchants can accept digital dollar payments and settle near instantly via Solana Pay, bypassing typical 2 to 3% card processing fees. Other collaborations include MasterCard's crypto credential initiatives, card network pilots, and enterprise platforms focused on tokenized deposits and supply chain finance. Liquidity remains deep on both centralized exchanges and Solana's own decentralized venues, supporting efficient institutional flows and tight spreads. These elements, regulatory progress, pending ETF access, growing tokenized asset volumes, and enterprise integrations, demonstrate Solana's push forward. They show the network becoming infrastructure that traditional finance and everyday users can actually rely on for high-volume, real-time applications. While the technical evolution is clear, moving toward global ubiquity requires clearing significant structural hurdles that face high-throughput DLTs in general. First is ecosystem competition. Solana faces pressure from other high-performance platforms like Sui and Aptos. Second are network stability and consensus security considerations. The transition to a multi-client ecosystem via Firedancer introduces a far more robust fault tolerance model. This layout is capable of handling extreme transaction spikes without full network outages. This design enhances resilience compared to earlier technical challenges. Yet, the deployment of entirely new validator clients requires ongoing monitoring and security audits as the upgrade architecture matures. Finally, the global regulatory landscape remains dynamic. Jurisdictions continue refining how they classify and oversee smart contract platforms. While major asset managers are building regulated products around leading infrastructure, compliance requirements for specific decentralized applications remain critical. These requirements will be an important long-term consideration for sustainable growth. Adoption is a long-term process driven by real-world utility, community support, and continuous development. Drop your perspectives in the comments section below. Thanks for watching Crypto Pulse 360. Stay pulsed.